So thanks everyone for coming onto the call on time. Glad to see all of you guys. I think today we have both NTU and SUSS Investment CCA Groups with us today. I had the honor and the chance to actually meet some of your leaders through Zoom also to discuss with them what are some of the things that you guys will want to learn and what are some of the things that you guys will be looking for in your time as a student and as a CCA member. Right. So we are actually organizing iFAST. We are organizing a festival online, and during the festival we have quite a number of events. Right. So actually this festival will be held in collaboration with AllQuant. Right. So we have actually Patrick and Ingwan from AllQuant today. Right. So together we are organizing this online festival whereby there will be multiple sessions and there will also be a chance for you guys to be showcasing yourselves, learning a lot of things, and sharing your experience with the rest of our friends as well. So I'm very happy, very glad to have all of you guys here. Right. Let's start with maybe Patrick or Ingwan. Maybe you can introduce yourselves to the rest of us here.
Okay, I guess I'll go first. Okay, hello everyone. Very good evening to all of you. It's a Friday evening. I think really maybe not the best time to be discussing a topic as heavy as hedge funds. Okay, but anyway, just a bit of myself. My name is Eng Guan. You can call me Eng, or you can also call me Guan. I think people just call me by any other names. It doesn't really matter. Okay, and in terms of background, I started off in GIC more like 16, 17 years ago, which was my first job into the finance industry. And then over there, I was really kind of like allocated to do a job, which is called the fund of hedge funds. So back then in GIC, I was really kind of looking at all the different hedge funds out there, what kind of strategies they're doing. And that kind of really opened my eyes to the entire investment landscape out there. Okay. And right after GIC, I moved on over to investment banks, Credit Suisse and Barclays. But over at those banks, I'm not really doing investment type of work. I'm more doing valuation type of works. So I was looking after like structured products, complex derivatives that are being kind of like priced and sold by the investment banks to institutional clients. And after my stint in investment banks, I moved on to prop trading for a couple of years where I was kind of trading interest rate futures spreads. So I believe these are all very different from what you guys are doing, okay? So, and then after my stint over in prop trading, I went over to join a hedge fund where I was running a multi-strategy hedge fund with actually Patrick, who is also down here. I think he'll introduce himself later. And after the hedge fund stint of which I think spent about 5 years over there, and we started our own company, AllQuant. So AllQuant is basically a specialized investment education company where we try to teach retail people how to invest by not using the conventional methods, by using approaches that we ourselves have kind of used and applied in the hedge funds that we have run before. All right. And on top of that, we also kind of like work with or collaborate with industry partners like iFAST to kind of introduce more options to retail investors out there. Okay. Yep. So by and large, just about me. So Patrick, you want to add on?
Yeah, sure. Hello, everyone. Very good evening to all of you. Thanks for joining this session. So basically, I'm around the same age as Ingwan. So in terms of experience, we share pretty similar background. So myself, I started out working for UBS, which is a private bank. So when I was there, I was a portfolio manager. So basically, we are responsible for implementing discretionary portfolio management solutions for the private clients of the bank. So I was there for, I think, coming to 2 years. Then after that, I went overseas, specifically Hong Kong, to take on an investment banking job. So my role over there was that of a salesperson. So I was actually attached to a trading desk, but my job there was basically to interact with hedge fund clients. So trying to get them to trade through our bank's platform. So I was dealing with equity derivative products. So maybe if you're not too sure what it is, in simple terms, it's basically just stock options. But instead of using options, they use over-the-counter product, which is basically customized products that the clients deal with the bank. So over there, I got to learn about this thing called volatility, which actually opened up my eyes to an entirely new asset class. So in fact, if you come for our festival, right, I will be sharing with you guys like what exactly is volatility and how you can actually use it as a very important cornerstone of your investment portfolio. Okay, because volatility has very interesting characteristics, right, that can actually help you to hedge your portfolio during crisis times. So following that stint in Hong Kong, I came back to Singapore. That's where I actually caught up with Ingwan again. And then together, we actually worked in this multi-strategy hedge fund, which Ingwan shared with you earlier. Yeah, so from there on, basically our path was basically the same. So that's where we are here today now. But interestingly, I think the story behind, okay, so career is one thing, right? But the bigger story behind how we actually came together and started this venture is that actually both of us are very interested in investing, right? So, but we developed our own unique way of approaching the market. So I have my own way and Ingwan has his own way, but we found out that actually it's very complementary in approach. So that's why we thought that why don't we put together, the skills that we have, and then we came out with this multi-strategy approach, which again, we're going to share during the festival. So, yep. So that's all we have by way of introduction. So yeah, maybe Tao, you can take over.
Thanks, Ingwan and Patrick, for sharing about yourselves. I just realized that actually I haven't shared about myself. So anyway, for those of you who haven't met me before, I'm Da Wei. Okay, so I'm an investment advisor from iFAST. And iFAST actually, as a platform, we have been around for many years, more than 20 years already, right? And some of you may be familiar with Fund Supermart, right? So actually, iFAST, we started from Fund Supermart, and slowly we grew into a bigger corporation, and now we are listed on the Singapore Exchange, right, as iFAST Corporation. So it has been a long journey. So as a platform, as an investment platform, we have taken a multitude range of clients. And clients, so far, we do have a rather nice number of investment in our platform currently. Right? So some of you guys might have seen some investment news. Right? Let's not talk about iFAST first. We have actually seen Endow Us and Scythe, some of the robo-advisors that have been coming up nowadays. Right? Some of you guys might even have already invested a little through them. Right? One of them actually announced crossing USD 1 billion assets under management lately. Right? So we are very excited for the whole investment industry and landscape. iFAST, we are still currently around more than 10 billion USD for the assets that we're managing. Right? But even so, we are still seeing that across the industry, even through the banks, right, no matter how far we've come, the industry still lacks a lot of support into a different way of investing. So a lot of times we are looking at fundamentals. So when we look at things like our price to earning ratios, when we look at things like, let's say we are investing in a country, how much GDP is this country having, what's its GDP growth rate, right? What's its level of foreign reserves, right? How is, if you're looking at a single company, how are we confident that the earnings for this company is going to go up over time? A lot of these are all fundamentals, and these are what we call qualitative investing. But yet on the other side of the spectrum, quantitative investing is when we look at very different things. Right? Yes, your fundamentals still are important and relevant to some extent for every kind of investor, but the world of quantitative investing, that is something that is very different and lacking a lot in support for a lot of people, especially in the retail sector. So today we have Ingwan and Patrick here, who will be sharing on quantitative investing. A lot of quantitative investing is actually done through hedge funds. Right? And you guys may or may not have heard a lot about hedge funds, and there's a special reason why actually hedge funds, they are not something that a lot of us have heard about, or even if we have heard about them, we may not be familiar with them. Right? So today we are going to learn a lot from AllQuant. Right, so maybe I can hand over the time to you guys.
Okay, thank you, Tawei. Okay, so I don't know how much you guys actually know about hedge funds in general. I believe, or when I was your age or when I was back in school, I've never heard of hedge funds. Okay, the first time I ever heard of hedge funds was when I entered GIC. Okay, so by nature of the job, I get to interact with hedge fund and I get exposure to them, and that's how I learned about what they are and what they do. So even if you know about hedge funds, most of the things that you pick up are largely from the mainstream news, the social media, and all that. So I can tell you that they don't exactly represent or reflect the real situation in the industry. So you want to know the real stuff, you got to hear it from the insiders, the people who are inside there. Okay. So for today's session, it's going to be a very general light topic where I just broadly introduce to you what hedge funds are, as compared against, let's say, the traditional mutual fund industry or the unit trust that you're typically invest in. Okay, so let me now share my slides. Oops, let me go back. Okay, everyone can see, yeah? Okay, so first thing, what are hedge funds? Okay, have you ever come across hedge funds that actually advertise on like your train advertisements, or let's say on the social media advertisements like Facebook, or even on, let's say, any websites? I believe not. If you see, tell me, I'm going to report him to the MAS. So why do you not see such things? But you see a lot of advertisements, let's say from Endowers or from, let's say, Stashaway, the robot advisors, as well as Aberdeen, Fidelity. You see them everywhere, okay, but not hedge funds. And why is that so? Because they are prevented or prohibited from doing so by regulations, okay? So under the regulations, in fact, it's a worldwide regulation. It's not just MAS. So hedge funds can only market or solicit funds from what we call accredited and institutional investors. So they can't market to the average man on the street. Okay, it's prohibited by regulations to do so. So what they can do is only to kind of reach out to these high net worth people. So accredited investors are largely high net worth people who has, let's say, more than $2 million in assets, or they make more than 300,000 in the last 12 months. Okay, or they can also be corporations. But if you are a corporation, you must hold an asset in excess of $10 million. Okay, if you can't just go about set up a company and call yourself a corporation and try to invest in a hedge fund. So if you don't have $10 million in assets, they're going to drill down to each and every shareholder inside the company and make sure each and every one of you is an accredited investor. Okay. Then the other class is institutions. So institutions are not just companies. So institutions are really the so-called the licensed or certified entity bodies out there. Like, for example, your government bodies, your government agencies, or it could be your banks, your brokers, your funds. Those companies that actually hold a license, properly audited and certified. So hedge funds can only reach out to this group of people to actually market their products and raise funds for them. Okay, so that's the first part, regulation. Okay, secondly, fee structure. So there's also a difference in terms of the fee structures being offered by hedge funds and mutual funds. So in mutual funds or unit trusts that you go and see, you pull out that fund fact sheet and you go and do research, you probably see things like your annual expense ratio. So that percentage actually captures like all the fees related to running this fund itself, which includes your management fees, which includes your like marketing, distribution, fund administration, and everything. So, but for hedge funds, they do it differently. Okay, the fee structure is usually what we call the 220 or the common fee structure, or it's not the only one. So what happened is this 220 actually means a management fee of 2%, okay, and a performance fee of 20%. So the management fee is the typical fee that is also charged within a unit trust and mutual fund. They're the same thing. But the performance fee is a special addition, which mutual funds don't charge. So what do you mean by performance fee? That means they take a 20% cut of the profits they make for the clients. So imagine you're a $100 million fund. So you make $10 million this year. So in terms of management fee, you'll be roughly taking about 2 to 2.2 million. That's 2% out of the range of 100 to 110. Then in terms of performance fee, you're going to take 20% of the 10 million profits you make, so another 2 million. So in total, the hedge fund will profit about 4 million or so, right, from this particular performance itself. Okay, and aside from that, okay, these are the 220, these are the management and performance fee. Usually the fund running expenses are not shown on, let's say, hedge fund fact sheets that you find out there. So you want to find out the running expenses, like the fund administration, as well as marketing and distribution costs. Those are usually only detailed inside the fund prospectus or the, what we call the PPM, the private memorandum. All right. Okay, so this is the fee structure. That's the second difference. And the third difference is what we call liquidity. So mutual funds, you can actually buy and sell at the close of every single day, right? Or for stocks, you can just trade off the exchange anytime it is open during the regular hours. But for hedge funds, it's different. Hedge funds is a lot less liquid. Okay, so it has what we call a very low subscription and redemption frequency. Usually hedge funds, you can't just go there and say, hey, I want to buy into hedge fund today, or I want to sell my current shares today. So they have prescribed periods where you can subscribe or redeem. Okay, so usually a very liquid hedge fund will offer you things like monthly liquidity, meaning that you can subscribe and redeem only once a month. And very common, you'll find most offer actually quarterly, semi-annual, or even annual liquidity. That means you can only do it once a year. All right. And the next thing is hedge funds typically cannot accept small little investments. So mutual funds is open to anyone. You can you can start an investment with 1,000, 2,000, or 5,000, and subsequently when you top up, it may be in 500s or 1,000. Hedge funds, no. Okay, hedge funds by regulation, they have to accept at least, like in Singapore, I think it's 200,000 as a minimum size of investment. But usually the more established hedge funds is going to charge you like, will only accept, right, investments like in the forms of 5 million, 10 million, 15, or even 20 million. Okay, so if you don't have that kind of amount, you will not be able to invest in those type of hedge funds. And some of them also implement what we call lockup periods, which is not typically not seen in mutual funds or unit trusts. Meaning is you invest in my fund, if let's say I impose what I call a hard lockup of 3 years, you will not be able to pull out your funds, right? Only until after 3 years later, then can you be pulling out your fund. So this is what we meant by lockup period. And depending on the strategy the hedge fund pursue, this lockup periods can vary. Very common, you'll find like 1 year lockup, 3 year lockups, 5 year. Or for hedge funds that pursue very illiquid investments like land, unlisted companies and all that, they can even go to extend to 10 years. That means for 10 years, your money is going to stay inside the fund, right, without ever seeing it. Okay, but compared to CPF, there's nothing, 10 years. All right, now liquidity. And then the next thing is, okay, now we hear a lot of things like, well, hedge funds got a lot of restrictions, right? So why would anybody ever want to consider investing in hedge funds? Okay, that is because in return for accepting this type of like regulatory limits, hedge funds in turn can do a lot of things that mutual funds are not allowed to do. For example, short selling. Hedge funds can short sell. Mutual funds cannot, right? So they can take bets on both directions, whether long or short. Hedge funds can leverage. Mutual funds cannot, right? Hedge funds can really leverage up to, leverage, in case you don't know, leverage is meaning just margin financing. So hedge funds can borrow money to increase the size of their bets. So the hedge funds can leverage 2 times, 3 times, 5 times, and those trading like spread strategies sometimes can actually extend their leverage to like as much as 20, 30 times. Okay? So this will be unheard of, right, within the retail scene, but this is what can happen within the hedge fund side. And they're free to use options and derivatives. In fact, the entire fund can be made up of options and derivatives. But the use of options and derivatives inside mutual funds usually is limited to a very small amount for hedging purposes only, right? But hedge funds, there's no such restrictions. And holding period, it can be very short term, can be medium term, can be long term, up to the high frequency where the hedge funds can just trade in and out in the nanoseconds, right? So hedge funds has a lot of possibility out here. and concentration. So in mutual funds, you typically don't see, you see a position size of 5% is huge, right? In hedge funds, they can take very, very concentrated positions that can dump a 50% onto a single position. So that can be found, all right? So they don't have a portfolio like what mutual funds build 50 to 100 different securities. They may run as few as just 10 securities, 20 or 30. Okay? And they can invest in anything, even in liquid stuff. I can go there, buy down a shopping center, and buy down a hotel, or buy a piece of land waiting for it to be developed. I can buy gold mines. I can buy uranium mines. So basically, to describe it, no holds barred. They can do practically just about anything you want. So in terms of the landscape they have is a lot wider than what the traditional products out there that mutual funds can do, all right? Okay, and because they're able to do all this, that's why you will see a lot of different types of strategies available out there to the hedge funds. So hedge funds are unlike mutual funds, which are segregated usually by asset class and geographies. Okay, like maybe you trade your stock mutual fund focusing on US. So usually that's how they segregate the mutual funds. But in terms of hedge funds, they're usually segregated or categorized into strategy silos. So there are a lot of different types of strategies out there. Yeah? So there's equity long short, relative value, global macro, fixed income, arbitrage, distressed securities, event-driven, CTA, which is a short form that represents commodity trading advisors. And there's also fund of funds. Okay, we'll look at some of these strategies later on, but these are the different types of strategies that they can run. And their performance profile tends to be quite uncorrelated from your broad markets. So when your market is up, these hedge funds may not be up. But when your market is down, these hedge funds may not be down also. So that's what we meant by uncorrelated, because they are pursuing a very different type of strategies. They're not just buying stocks, holding there, or reducing the positions and increasing the positions only. So they're doing a lot of other things, right? So these are the type of strategies that are generally out there within the hedge fund world. Okay, and because of that, most hedge funds are what we call, or uses what we call absolute return benchmark. So for mutual funds, most of them actually pursue like buying stock. They're really just stock picking. So they wrap their strategies around an index like a market benchmark, let's say S&P 500 or your STI stocks, and then they buy or they weight a component of the stocks according to whether they think the stock is good or whether the stock is bad. So their outperformance or underperformance can be measured directly and objectively using a bucket benchmark like S&P 500 or the STI, okay, depending on which market you're trading. But for hedge funds, no, that cannot be done because the hedge fund is pursuing, let's say I do a long shot. So how do you want to compare me against the STI or let's say the S&P 500? It wouldn't be a fair or objective comparison. And the selling point about hedge funds is that they're telling you they are trying to produce you a return regardless of how or what the market is doing. So the market can be up, I can be up or down. The market can be down, but I can be up also. So that's one of the very key attractive point about hedge funds. So they produce an uncorrelated stream of returns for you. And because of that, most of them does not follow or have what we call a market benchmark. They usually give you what we call the absolute return. That means they quote a figure to it. Let's say I want to return 10% every year. So this is my benchmark. Or maybe they may quote things like LIBOR plus 5%. So depending on where LIBOR is trading right now, LIBOR is, I think, 0. something percent. So plus 5%, then maybe 5.1% is my current benchmark to beat, right, in terms of gauging my performance. Okay, so, okay, so that roughly in a nutshell, right, is about some broad features of how hedge fund is different from your traditional mutual funds. So now let's take a look at the current state of hedge funds. Okay, I believe many of you may have already come across or read about news saying that, oh, hedge funds are languishing behind, the performance is bad, you know? And some may even read about having hedge funds gaining a very bad reputation. In fact, I have a recent question in Quora, which I answer questions on Quora, by the way. And this guy was asking why would people invest in hedge funds now, having all this bad reputation so far? Okay, I think even Warren Buffett is not very in favor of hedge funds as a total. Okay, but what you see or what you hear typically from all this mainstream news, all the social media, and all these funny people asking questions out of nowhere, typically doesn't reflect what is happening on the ground. So if you look at this particular chart down here, it shows you the growth of the assets under management in hedge funds over time since 2010. Okay, when I joined GIC in 2006, they were actually less than 1 trillion. Okay, so now they are, in 2010, they are above 1 trillion, and they've been steadily growing all the way, right? Projected all the way up to 2025, I think they're projected to grow to over $4 trillion. Okay, this is definitely not something you would expect of an industry that has a bad reputation. Okay, clearly it's growing because there is a demand in terms of the skill sets and the service they are providing. Okay, and they are not targeting the man on the street now. Usually the man on the street will only look at how much I can make, things like that. But hedge funds are targeting the high net worth as well as the institutional people who are looking for ways to diversify out of their original portfolio, right? Okay, so if you look at it, I think 4 trillion is a good number. It's still small, still compared to, let's say, the mutual fund industry. I think US alone, the mutual fund industry, there's already more than 30 trillion, but it's still a fairly sizable industry and it's still growing, all right? Okay, so that is the, and in terms of performance, okay, the most successful hedge fund in the world actually throws probably every single fund it can find out their way, right? So this is you may have heard of the Renaissance Technologies Medallion Fund. Okay, it was run by a professor called Jim Simons. He's an academic before he set up this particular fund itself. And it has been in operation since 1988 or 1989 for 33 years. So every year, on average, it makes after fees 39% per year. Okay? And that is after fees. So if you want to know the fees that this particular fund charges, the fund charge is actually 5% on management fee, okay, which is the highest in the entire world. And it charges 44% performance fee. That means for every $1 profit you make, I'm going to take 44 cents away. And even after that, it makes 39%. So if you reverse out all the fees, this particular fund actually makes almost 70% every year in terms of raw return for 33 years. There was not a single down year, even through all the market downturns, not a single down year. Okay, so, but the bad news is, even if you're rich, you can't invest in this fund anymore. It's closed. So they basically grown so successful that they return all the money back to all the external investors. They close it down and they only trade and invest their own internal capital right now. Yeah, and the fund size, I think, is about $10 billion. But this company is a lot larger than that. They have several other funds. I think the company is, I think, managing well over $100 billion in terms of the assets under management. Okay, so this is Renaissance Technologies Medallion Fund. Okay, so the next thing to show you is how hedge fund as a whole. So just now I showed you the extreme result, right? So you're thinking that one extreme result is a special case. Okay, so now you want to see how hedge funds in aggregate as an average perform against your traditional stock market. So this is the chart they're going to show you. So the blue line over here represents the aggregate average performance of hedge funds since 1990. Okay, the gray line, what's the gray line? The gray line is our Singapore stock market. Okay, and the orange line over here is the world stock market. Okay, so basically I make use of the MSCI indices, right? And all of them are measured in terms of USD. So that is objective comparison here. Right? For hedge funds, I'm using, if you heard of, it's called the Hedge Fund Research Index, right? Which is published, I think, free of charge. You can actually go and do a Google and search on it. So the information is all there. So if you look at it, right? So over the later part since 2009, right? Hedge funds does indeed have been lagging behind the stock market, because the stock market basically every year is going up and up and up like nobody business. Because after the I think the Fed and the worldwide central banks start pumping liquidity into the markets. All right, the money got to go somewhere. So it ended up inflating a lot of assets, not just the stocks, but the stocks have been ramping up very fast. Okay, that's why in terms of returns after 2009, I think the hedge fund as a whole kind of pales in comparison when compared to the stock market. Right? But if you take all the way back from 1990, the hedge fund has a very, very good head start and is still leading by a wide margin against the other two markets, right? So the other two markets, you want to catch up the hedge fund, I think there's still a long way to go. All right, and the next chart is going to see is the value that actually hedge fund provides you, right? So it provides you the value, or you see the value during crises. All right, so these are the 4 different crises over the period that I have kind of like segmented out. But the first one is during the Iraq invasion of Kuwait, right? Back in 1990 to September 1990. I think none of you would have probably experienced that. I was also a small little kid back at that time. So, but in general, I think the world stock market crashed like 20%. But hedge funds actually went up 3 and 4%. So that's what I meant when I say uncorrelated. So why did the entire market went down and yet the hedge fund is able to profit out of the whole incident? Then during the dot-com crisis, markets fell like 40, 50%, but hedge funds edged out down 2%. It's almost flat, which is considered really good, right? But subsequently, I think in the later years, like your great financial crisis, starting from 08-09 to the COVID pandemic, hedge funds did fall more than relative to the 2 previous periods. But overall, if you look at it, it's still less than half of what your stock market actually loses as a whole. So there's value in terms of crisis protection and providing an uncorrelated stream of income, which is what institutions and a lot of high net worth people are looking for. How do I preserve my capital during such periods of time, right? Okay. So the next part we're going to show you is to talk a little bit about the different types of hedge fund strategies out there. Just deal with a little bit more depth. Okay, the first one is the largest, is equity long short as a term. So equity long short funds actually represent kind of the largest chunk of hedge fund strategies out there. Okay, and most of these managers actually are predominantly long only managers before they actually started their own hedge funds themselves. Okay, so I'm not so sure whether you're familiar with the concept of long only and short only kind of, but long only means you only buy, you don't short, basically, right? All right, and most of these equity long short hedge funds are what we call long buyers, meaning they tend to be, they do both long and short, but in terms of exposure, they are net long. Okay, so what happens is that you typically start with a stock universe in this fund. Let's say I trade US stocks, so I'll look at all the US stock universe. Then they will analyze, what are the stocks to buy, which stocks are good, and which are the stocks that are bad, right? And then after that, they will separate the two. So the stocks which thinks they are good, that's going to outperform, they'll put it in the long book. So you have a long exposure, and the stocks they think are bad, which is going to do badly, but they'll put it under the short book, and that's a short exposure, okay? And overall, because there are more longs than shorts, they are net long, right? So it's a long bias hedge fund, the long bias equity long short fund. And usually we also kind of take note of their total exposure. So some people think that, oh, wow, I'm long and short, so my net long exposure not very high, so my risk must be very low. But you got to understand also that you can lose money on the longs and lose money on the short at the same time. So when that happens, that means you might be kind of whacked on both sides. That's why we take note of this thing called gross, which specifies the gross exposure or the total exposure you have on the hedge funds. So hedge funds can run more than 100%. If you recall earlier, I said they can take leverage, right? So I can be, say, 150% long and 50% short. So my net long exposure is actually 100%. So if you look at it, I'm not leveraged. So I should be like quite safe. But no, because my gross is actually 150% plus 50%. That's 200%. So technically, if something goes wrong, you can go very wrong, right? When you actually host that type of leverage on you, all right? So this is long bias funds. Then the short bias equity will be the reverse. So instead of having more longs, they actually have more shorts. So they actually run a net short exposure down here. Okay, and this type of fund usually very rare, you won't find a lot because they can't make money. You want to be short against the equity market is, as a business, it is very hard to sustain because if people look at you, you are bleeding or losing money most of the time. Okay, but there are such funds around, but most of them have closed down. So it's statistically and in terms of probability wise, it's really hard to make a business out of it. If you want to make a business shorting, then your shorts got to be really, really, really good and accurate, right? So, but there are such funds around, and there are institutions that are looking out for good short buyers funds, right? And the next type you heard of is market neutral. Okay, market neutral funds are typically also long short funds. What happens is that they structure their long exposure and short exposure according to beta. Okay, so beta is the sensitivity of the portfolio's kind of risk, right, to the market itself. So they structure such that both the long and the short beta is the same as each other, and they cancel out. So they call it the market neutral funds. But there are many, many other type of neutral funds out there. Some people call them market neutral, but actually they don't size it according to beta. They size it according to the dollar sizing. That means I short $50 million in, I long $50 million, I short $50 million. I call myself market neutral. So that really is not the true market neutral. That is dollar neutral. Right? So in market neutral funds, we're explicitly looking at beta neutral, right? So I don't know whether that confused you or not, but I hope not. Okay, then there are others that pursue strategies that factor neutral. That means they go beyond beta. They may look at things like size, growth, momentum, and all that, right? So this is the market neutral funds. And the next type of very popular strategy is called arbitrage. So in arbitrage funds, the keyword here to know is called mispricing. It's basically talking about temporary dislocation in prices between like two related products, or what you perceive to be a mispricing between two products itself. Okay, so for a simple example of this, let's say you have you want to do an ETF arbitrage, right? So you have the S&P 500 ETF trading in exchange. So when it trades in the exchange, it's subject to market forces, your demand and supply, right? But at the same time, the ETF SPY is actually holding or representing a basket of stocks that represents the S&P 500. So it has its own net asset value, right? So what happened is that when, okay, in this case, when the net asset value of the S&P 500 stocks held in the SPY ETF is actually bigger than what the ETF, and the price the ETF is actually trading in the market right now, then that represents what we call an arbitrage opportunity. Because essentially what I can do is I can go and short sell a portfolio of the S&P 500 stocks, and then I can buy the S&P 500 ETF. Because if these are two equivalent products and basket, there's no reason why the prices should be different. So eventually they're going to converge. And when they converge, I make that tiny little spread of it. Okay, so this is ETF arbitrage. Okay, and it happens the other way around. Then what you can do is that you sell the ETF, then you buy the S&P 500 stocks. So if the mispricing happens the opposite way. Okay, but this type of ETF arbitrage is very hard to execute nowadays because the market is now so competitive and there's so many people trading. Usually if it happens, it won't be you who get it. Somebody else that does the electronic trading and use those super fast computers will be the one that get the opportunity first. Okay, and so this is really left to what hedge funds does. Okay, and besides ETF, there are other forms of arbitrage. So you can arbitrage between futures. There's also merger arbitrage. You can arbitrage convertibles. There's volatility arbitrage, fixed income arbitrage, and statistical arbitrage. All right. Okay, then there's another type of hedge fund strategy, which is called the global macro. So basically, these are your gung-ho traders type, like your George Soros, and even Ray Dalio. Even Ray Dalio can be considered, or the Bridgewater Associates, the largest hedge fund in the world. So they're all considered kind of like macro. So macro meaning they actually look at very high level stuff, macro views. They don't go down, they usually don't, but they can. They usually don't go down to trade like individual stocks and study company and fundamentals like that. So they're going to take bets like, oh, which FX is going to go up, which is going to go down. They play that U curve. Maybe they think the inflation is coming up next, and they want to play the flattening, the curve flattening trade or the steepener trade. So these are things that they look at, and they take huge directional bets, long or short, according to their views of what they think is going to pan out. Or they may wrap their trades around certain themes that they think are evolving out of the markets now. So these are usually the hedge funds that place very concentrated and big bets. And these are usually, if you want to hear a good story, you go to a global macro manager. They'll be able to tell you good stories about the market or why they're putting on the trades. Yeah. Okay. The next one is commodity trading advisors, which is the CTA, which you see just now in the earlier slide. So typically these are quantitative funds, or they run what we call systematic strategies, where a lot of things are automated and traded according to computer models itself. Most of them started off as what we call trend followers, means they implement trend following strategies across all different markets and let's say and asset classes. So they can trade FX, they can trade commodities, they can trade equities, they can trade interest rates, instruments like bonds. So although the name is commodity trading advisors, they don't really only just trade commodities. So it's a whole wide range of things that they look at. And while predominantly, I think they're still trend following, meaning they implement trend following type of strategies, but they have now evolved to go into other types of strategy as well, right? Then vol trading. So vol trading is something, okay, there's another asset class called volatility, right? Which I think the hedge funds are fairly active in, but the retail hardly would have kind of like exposure to this type of strategies itself. And I think Patrick is more of an expert in this. So essentially what they do and trade is they use options and volatility instruments like your fixed futures. I'm not sure whether you heard of it. And maybe the volatility ETFs like your VSX, SVXY, and all those things. And on the institutional side, they also offer things like your volatility swaps, variance swaps, and all that, which is not available to retail, but they trade all those stuffs anyway. And they can take a long short positions. In a way, it's a bit like your equity long short, but now they're trading vol. So kind of to trade vol, hard to simplify it, but what happens is that they will buy options, right? Let's say on a particular stock, which they think the current vol that is priced in the market now is too low and they think it's going to go up, right? Or they think the volatility should be higher. So the particular option is actually priced lower than what it should be or what they feel it should be. So they buy the particular option and then they, what we call delta hedge, right? They delta hedge by shorting the stock of that particular call option. They'll kind of neutralize away the delta of the particular call option, so that whatever moves up and down, right, will be more according to the directions that they have, right, on the particular option, right, on the vol itself, not so much the price. So they try to kind of hatch out the other risks involved in the option in order to capture only the volatility component in it. Okay, so this is like vol arbitrage or long short. Okay, then the next one and strategy is, this one is quite layman, multi-strategy and fund of funds. So basically there are funds out there that are diversified across many different types of strategies. And there are two groups, right? One is called multi-strategy. So multi-strategy is actually a single fund, one single fund. So within that one single fund, they implement multiple different strategies. So inside there, you may have people that do global macro, you may have people that do equity long short, you may have people that focus on equities, people that focus on fixed income, many different things. So, but they run all of that within a single fund in-house. So all the expertise is within that particular fund itself. So the good point about that is that you have greater control, right? And the in-house expertise is inside there, and they are able to charge you lower fees. Okay. The other alternative is if we want to diversify across different strategy is to go to look for what we call a fund of funds. So fund of fund is basically a fund that allocate money to other funds. Okay, my first job, I was doing that back in the GIC. I was basically doing a fund of funds function. So what they do is they pick out the good funds, they structure their entire portfolio, and then they kind of like allocate their money to each and every individual fund that they think has, which is good to add into the portfolio itself. So the good thing about it is they have wider choice because there's so many funds out there, right? So you can actually slowly go around and pick the best out of it. So that's the one of the advantage. And of course, you will be able to achieve more extensive diversification. You can have 30, 40, 50 different funds inside your entire portfolio. Might not an issue at all. But the downside is that you have less control. So because the fund of funds, they don't have the in-house expertise within there. So the in-house expertise all resides within the individual funds they invest in, and they have no control over this fund. So definitely they have less control and visibility over what the funds are actually doing out there. And of course, the fund of funds themselves are a fund, so they need to charge fees. So they would, on top of these underlying funds, which already charge you fees, right? They would charge another layer on top of it. Okay. So that's why I think this fund of funds is generally also kind of like a dying business. There are still some big ones out there, but they're no longer kind of like as popular as it used to be. And within the large institutions like pension funds, they don't need a fund of funds because they themselves can actually do it themselves, right? Okay, so now I think Dawei has. Okay, so basically that sums up the introduction to hedge funds that I basically wanted to show you guys out there. So the next thing I want to move on is to talk about that little challenge that I think Dawei I've alluded to you that wanted you to participate in. Okay, as a simple exercise. Okay, so this challenge that we're gonna we thought about what to give you, right? So I think the thing that we actually came up with, right, is to do a simple asset allocation exercise, right? Because I think most of you are more comfortable kind of like with stocks. You've been doing fundamentals, analyzing companies. Correct me if I'm wrong. So that's what I think. Because back then when I was in school myself, the only things that I know of is stocks. Okay, and I only look at in stocks and then I study them. Okay, but it would be good if you look beyond just stocks and see for yourself what the entire forest actually looks like, rather than just focusing on a very small portion of it, right? So I think this exercise would be good in the sense that you can step back, go higher, and look at things from a more macro perspective. So essentially what we thought of to let you guys do, right, is to construct a portfolio, right, using different asset classes out there, okay? And then explain your methodology. For example, you may find things like those 60-40 portfolio, 20-80 portfolio, 30-70, or equal-weighted portfolios out there, right? So these are examples of like asset allocations, right? So it can be any of those, or if you do a Google search, you'll find a lot of different kinds of asset allocation methodologies out there as well, which you can actually kind of like study deeper into it to help you actually create a portfolio. So basically, there's only two main questions you need to answer in any asset allocation exercise. The first thing is, what assets do you want to choose to put inside your portfolio? This is very important, because if you choose the wrong assets, then the diversification effect is not going to be, it's not going to be as great as it should be. And it kind of defeats the purpose of you diversifying. For example, you choose everything is stocks. When the market falls, what happened? You fall as well, right? So if market goes up, you goes up as well. Then what do you diversify, right? You diversify, you want to get or reap the maximum benefits out of it, then you probably have to look into different types of asset classes and how they can complement each other. So choice of assets is one. The second one, after deciding the choice of assets that you want to put inside a portfolio, you got to be looking at how do you want to allocate to each and every one of those assets, right? Do you want to equally weight them? Or if you don't want to equally weight them, you want to overweight one of them, underweight the other. So these are questions that you need to ask yourself. Okay, and there are methodologies out there which you can Google, which will tell you how you can actually do it, right, in a more effective way. All right. Okay, and next thing is after the allocation, and you got to consider things like also rebalancing. So I know I'm not sure whether you know what rebalancing is. So rebalancing is basically like when you set an original asset allocation, let's say it's 50-50, after some time it's going to move away, right? So you will need to rebalance to bring the allocation back, right? So these are like simple rebalancing methods for a fixed allocation methodology. But there are other more dynamic ones like risk parity and all that actually kind of like changes the weight of your changes your allocation on a regular basis. All right, so we can We can share more of that in the next session. In the next session that you're going to have with us. Okay, but for now, this is something that you need to take note of. And have you done backtesting before? I'm not so sure whether you've done backtesting before. So, but the concept is there. So ideally, after having the choice of assets as well as the allocation methodology, you will want to backtest, meaning you go back into the history and test out your methodology, whether it works or not, right? So in hedge funds, we always do that, right? Especially with a new investment strategy that we want to try out. Because it's very simple, right? I mean, I want to know how well they perform, right? Not based on what I think, what I thought, because honestly speaking, what you think, what you thought doesn't matter much, right? You got to prove it that it works. So if something you think about doesn't even work in the past, then what is your basis of it even working going forward, right? So this is just pure common sense. Then the universe that you can choose from, I think it's best to select ETFs. Okay, so you can use any ETFs that you actually like to use. And in terms of resource prices, well, all ETFs are listed. You can get it off from Yahoo Finance, right? You can Google. And backtesting tool, you can make use of Microsoft Excel, which I think most of you would have it on hand, but if you know how to use it. But if some of you are more advanced in terms of programming, you can use R, you can use Python, that's perfectly fine as well, right? Or if not, you need help, you can go to this thing called Portfolio Visualizer. Okay, it's an online web-based tool where you can just key in the ticker, key in the asset allocations, right? And then it will help you generate a very nice chart with all the performance metrics that you need. Okay, but you have less control over what you can do with this thing. Basically, you would have to kind of key in the allocations yourself. All right, okay. And Zoom session, I think this one, I leave it to Tawi to talk more about it. Okay, so by and large, I think that is what I want to say. Now, any questions? You guys open to the floor. So just keep it informal. Any questions, just fire away. Now, if you don't want to talk, you want to type, you can type it in the chat as well. Okay.
Okay, sorry to ask, but this is actually related to the presentation that you gave just now. So you mentioned that most people actually have misconceptions about hedge funds. So what is one common misconception that people have? Like, do people normally think they are risk takers or things like that?
Yes. This is one of the big misconceptions which you just mentioned, because what happens is that people read from news, like mainstream news. So, and because hedge funds are able to do almost everything, so you'll find extremes on both ends, okay, which are newsworthy on both sides. So what do news like to report? They like to report extreme returns, or the very big and large guys doing some stuff, or they like to report those that blow up. So with the kind of strategies that hedge funds tend to pursue, you definitely find some on the other end of the spectrum where they take very high risks, like very high leverage, and then they blow up. For example, in recent case, there's this, it's a family office now, by Bill Huang.
Family office.
Right.
So,
yeah.
Sorry, family office is a bit like hedge fund, right?
They can do hedge fund stuff in the sense that because if you are a single family office, you don't need to be regulated. So you're just like a personal investor now, but you're very rich. So you can do whatever you want. You can do whatever you want. Yeah. But there are those that run multiple family offices, and those needs to be regulated. Yeah. But essentially, they are like a hedge fund, but they manage only, let's say, a single family or the monies of a few families. That's called family office structures. Yeah.
Okay. Because I think this stereotype actually is perpetuated by the mass media. In particular, I think there's a certain US drama. I'm not sure what's the title of that drama. They actually it's a US drama. I think they make fun of they're making fun of the fact that they take a lot of risks and they live life very dangerously and stuff like that.
Actually, there are quite a lot. I mean, in real world, there are quite a lot of episodes where the hedge funds actually blow up. For example, LTCM is one, right? A long time ago, LTCM is a hedge fund. It's a hedge fund. So they were trading spreads, but they were extremely and highly leveraged on the spread bets. The thing with when you trade spread, because you make only a little money each time. So if you make only that little money, even if you're consistently making money, it doesn't mean a lot to the people out there. So what happens to amplify the kind of returns that they can make? They actually take a lot of leverage. I think LTCM take like 30 over times leverage. So when the things go haywire, and in what we call tail risk, which sometimes happen, the whole thing just get whacked. So their fund entirely collapsed. So the thing with this type of spread strategies that you see, like arbitrage, all this, when nothing happens, you see a very smooth going up curve. Wow, like it's a very safe fund, right? But that's because a lot of times you haven't seen what we call the tails yet, right? So when the tail event hit them, they can drop very fast. Yeah.
But I recall it's because I think they're into Russian debt, right? They were trading Russian debts.
Yeah, they were trading Russian debts.
Sorry, Wei Seng, I know the drama series that you're referring to. I believe it's called Billions. Billions, right?
Oh, I'm not very sure. I've only
okay.
all
Anyway,
I did was
I watched that drama series.
watch.
Yeah.
But
I
it's
watched
not
that drama
very
series. So the main perpetrator of that drama series, right, is a guy called Bobby Axelrod.
Okay.
So he runs his firm is called Axelrod Capital.
Appears to be multi-strategy if I'm not wrong. It looks multi-strategy to me.
No, actually what they pursue, right, it's very, very concentrated discretionary bets. They're pretty, I think the story is pretty much modeled after, if you know who is Steve Cohen.
SAC.
Yeah, SAC
Yes,
Capital.
SAC.
So the drama is actually loosely modeled around SAC Capital. So if you watch the drama, right, there's a lot of little stories about how, you know, their senior traders, right, go and get some inside stories from some outside people. Basically, it's so-called insider information. Then they leverage on the insider information to put on big bets, and then from that they make a lot of money.
But of course, it's illegal unless you classify as Mosaic, right? MOSAIC.
Yeah. So in fact, in the drama series, some of the traders got into trouble with the authorities.
Okay.
Yeah. So anyway, a side note is that if you guys, the next time you all hear about, or rather if you all read stories about fund blowups, right, try to distinguish whether the funds being mentioned, right, what kind of strategy do they pursue? I think most of the time you will realize that the funds that actually got into the news, right, these are basically the cowboys. So they tend to take very large concentrated bets, and usually it's on a discretionary basis. So the story LTCM that blew up in the 80s, right? Sorry, blew up in the 90s. Yeah, 98, yeah. So that one, right, is actually an early story about how a quantitative fund actually, they thought that they have managed to hedge out their risk properly, but they actually took on too much leverage. And so because the leverage is the one that killed them. So when the Russian debt defaulted, right, they were not killed directly by the Russian debt. Basically, their portfolio is actually not entirely invested into Russian debt. But what happened is that all the little positions that they built up, right, all require this thing called liquidity premium. So meaning to say that the positions will do well when the market, right, has a lot of liquidity. So what happened was that when the Russian debt crisis happened, right, everybody basically, there's a premium being put onto those safe assets. So there's this thing called a flight to liquidity. So all the positions, right, even though it's diversified, but underlying those positions, right, is actually this inherently tied into liquidity. So when the liquidity squeeze happened, right, all the positions all correlated to one.
Yeah.
So that is why LTCM blew up. So I believe a lot of future quants, right, those who run quantitative strategies, they actually use this as a very good case study. So from this episode, right, a lot of them actually have learned from it. They have learned that even though you may have created a very stable portfolio, right, but do not put on excessive leverage. So there are people who actually try to gun for things like 30, 40% annual returns, right? But they know that it's not sustainable because in the event of a liquidity crisis, right, the funds can easily blow up.
Yeah.
So that's why nowadays, if you look at the modern quant funds, right, there are a lot of big quant funds out there, but you look at their returns, right, actually it's not very fantastic. These are not the kind of returns that will actually put them into the newspaper. That's why most of you will never have heard of them. So there is this quantitative fund called Medallion. Not sure whether you guys have heard of them. So if you go and do, if you go and research onto their kind of profile, right, their return profile is fantastic. It's basically like a straight line going out from left to the right. If you look at it, it looks like a Ponzi scheme kind of return profile. But if you look at their annualized return, right, it's actually nothing to shout about. It's maybe like, I would say about 10 to 12% per year. Yeah, so this kind of returns, right, people would actually scoff at it and say, "Che, 10 to 12%, I can also make it myself." But the important thing to note is that they are very consistent. So even in a very bad market condition, right, these guys still grind out 10 to 12%. So that is what makes them stand out. Yeah. Okay, I think I've spoken too much. So maybe move on to the next question.
Okay.
Yes. Does anyone else have any questions?
Maybe can I ask one question?
Yeah.
Okay, so let's say for you as a hedge fund manager, what do you think is a skill that has served you very well since the very start? A particular skill.
Maybe I'll go first. I think for me is I'm engineer by training. So actually not by training, by academic background. So it suits my personality well. Always been someone that is interested and good in mathematical stuff. Okay, so if you want to really kind of like go into investments, I think you really need a very logical and analytical mind, especially in terms of math and understanding the concepts and be able to grasp things like risk and rewards, right? So a lot of people out there only kind of like focus and look at returns. How do I predict the next crash, the next stock that is going to become the next Amazon and all that, right? But really, what about is investing is about kind of like understanding and mastering risk and not as well as returns. So risk is often a neglected part. Yep. So for me, I think that has kind of like panned out well on my side. I think the training I was given back in, I think starting in GIC, right, was a fantastic learning ground for me to know all these concepts and how the different strategies work. Yeah. So that for me, I think is the biggest thing. So Patrick?
Okay, for myself, I'm always a big believer in learning by doing. So, like personally for myself, right, right from the very beginning of my career, the moment I so-called managed to sock up a bit of savings, right, I just started to put it at risk in the capital markets. So from there, I mean, I really learned firsthand about the decisions that I make, right, have a direct impact on my well-being. So nothing teaches you more than really feeling it in a first-person perspective, because you can actually read a lot of theories and all that, but at the end of the day, the one that really internalizes it into your system, right, is really seeing it happening right before your eyes. So that's one. And then the second thing is, I think the thing that really helped me to be able to achieve a more consistent return in my own performance in terms of a personal portfolio, right, is the exposure to asset classes outside of equities. I mean, I think it's a very usual progress. When you first start off, right, the only thing you know about is stocks. Because every time you turn on the news, right, the only thing you care about is, oh, this company report these earnings, blah, blah, blah. And then you see the impact on their stock prices. So that's the first thing that we know when we enter the investment world. But then you realize that if you just invest 100% into stocks, right, most likely your portfolio will be very, very much dependent on how the economy is doing. So when the economy goes down, right, your portfolio will also go down. Cannot run away one. You can pick the best company out there, but in the bear market, your portfolio also gets hit. So the day that I learned that there are actually asset classes, right, that are non-correlated to asset equities, right, is the day that I realized that that's how you can actually create a more sustainable portfolio that can generate returns for you regardless of market condition. So to get exposure to the other asset classes, right, previously it was a bit more challenging because without exchange traded funds, right, there really isn't much instruments that you can invest in to gain exposure to the other asset classes. But these days, right, there are really a lot of other ETFs available in the market that really there's no more excuses for you to say that, oh, I'm not able to diversify. So I think if you want to explore how can you try to get yourself perhaps more versed in the hedge fund industry, right, is to try to start educating yourself about the different asset classes out there other than equities. Yeah, because it's really very interesting. Because, for example, just to give a very, very off-the-cuff example, right, is that you know that during the COVID crisis last year, right, in March, volatility itself, right, spiked up more than 100%. So imagine if you had a small proportion of your portfolio just invested in volatility as an asset class, right? That return from that portfolio, I mean, from that part of the portfolio itself, is able to offset the losses from the equities.
Yeah.
Yeah.
Okay,
So,
and maybe just to reinforce on the part Patrick talked about this going beyond just stocks. So I think there's a lot of people saying that you invest in stock, in the long run, you're never going to lose money. So very simple, I just point you to Japan. Okay, you just pull out the Japan of Nikkei 225 and you see how the Japan market move. All right, so if you note from there, from 1989, Japan entered into a depression or a downtrend all the way until 2009. So for 20 years, the market is just down. And now 30 over years, where is it trading? It hasn't recovered back to the peak. No. So if you think about it, no, stock market has its own risks. So these are things that has happened before. Will it happen again? I think nobody knows, but it's definitely one possibility. But as a good risk manager, what you want to do is you definitely don't want to be in a situation where it happens to you and, I mean, you have nothing to protect against it. Yeah. So these are what you do as a risk manager, rather than just relying on, oh, you see, stock market, you see just one trend up. But when you actually pull down and observe in detail, there are really a lot of small little incidents that happen. I can tell you that stocks is not as risk-free as you think it is. Okay.
Okay. Thank you, Ingo and Patrick, for sharing.
Yeah.
I do have to kind of cut the questions because we are running out of time. I have some important announcements to make. Right. So firstly, when we see the challenge over here on the screen, right? So for your leaders, you might remember that the challenge that I sent to you guys, it consists of 3 parts. Right? So the first part actually is still for your CCA to showcase yourselves. Right? Please showcase and let everyone know how you guys are trained, what background you all have. Right? Please use the time. Right? There will be that air time that we will give for you guys during the festival to talk about yourselves. Okay. And then this is the second part. So the second part, clearly you see that the basket of securities is the universe, right? The whole universe of ETFs. And the third part is actually still something that we want to go for, right? The third part is talking about how implementing some of these strategies, it might be a challenge for a retail investor. Okay. So although we get a chance to learn a lot about a lot of strategies, right, at the same time, we also want to keep things relevant for the audience. Right. So yes, it still applies, right? That challenge that I gave you guys. Okay. So that's announcement number 1. Okay. Announcement number 2, we are going to change the format of your submission. Right? Please submit video recordings, each team. Okay, we don't want to stress you guys, right? Please don't need to force yourselves to present live unless you guys want to. We are also going to move the dates for the festival a little, right? So if you guys want to, actually, we need to present sometime in late October. If you guys are very keen on presenting live, please let me know. But as of now, we can keep the dates still the same. We are going through this mentee training or traineeship with AllQuant. Right? So you guys can actually still continue to learn from them. The duration is still the same. So from now until the end of August, right, please keep looking for AllQuant. Please keep looking for Patrick and Ingwan. You'll see that they have their email in the chat. It is now your chance. It is not every day that we get professionals such as them, right? People who are experienced in the hedge fund management space and in Singapore some more, right, to share about this expertise. So please learn as much as you can from them, and we look forward to what you can produce. Okay. And I have the team leaders for each CCA. Is there someone to represent SUSS first? If you haven't decided, then internally arrow now. Okay, never mind. NTU first, if you are ready. No worry lah. The team is just for me to contact you guys, so it's easier liaising between us.
Our team leader is not ready here, so I think they just contact me. I think it's fine.
Okay.
Yeah. For SUSS, you can just contact me.
Okay.
Sadian. Yeah.
Sadia. Okay. Maybe you can leave your email, or do you have my email?
I'll just leave.
Yeah. I'll leave in the chat.
Okay, great. Okay, Ken. For NTU side, please let your leader come and email me so I can contact you guys. And please go ahead and schedule your first coaching session with AllQuant. Okay, please go and contact them through the email so that you can start learning from them. They will have things for you guys lah.
Can I ask something though? There's this 1 week, 2 week, 3 week, 3 finale. All this program is
okay.
Is that still happening?
Yes, they are still happening. Just that we have actually pushed the dates back. So we also don't want you guys to stress and think that you all need to present at a different date now. Right. So please go ahead with video recordings. If you want to present live, you can let me know and we can have a discussion about it. But if not, then let's just continue with video recordings now. Okay. I will give you guys more details about the video. There are some things that we need to keep in line. For example, the length of the video itself. Okay, so it's important that I'm contacting your leaders. Okay. Okay, great. Thank you, everyone. That's all for today. We look forward to a very wonderful session and learning journey that you guys have with AllQuant. And the festival itself, you guys will see the details coming out close to the end of this month. They will be on iFAST website. So the activities that you guys mentioned, the sessions that you guys mentioned about that week 1, week 2, week 3, they will happen and you guys will see it online. When they are available, I'll be sending the details or the links to your leaders so you guys can actually see yourselves up there also. Okay? Okay, great. Any last final questions that you guys have? If not, then that's all.
Sorry, Dawei. If we just have a bit of time, right? Maybe can we just get the two a representative from each of the CCA just to briefly tell us like what their CCA does? Don't have to say too much. Maybe 1 or 2 sentences will be.
So I think I can start first. So NTU, we are from NTU Investment Interactive Club. So it's IIC. I think it's one of the older investment clubs in NTU. I think if any of you guys were from NTU before, I think you guys should have heard of it. Yeah, but I think we are quite a new sub-segment in the club. It's called the Nigerian Student Investment Fund. So basically what we do is just recruiting students and then about 20 a year, and then we train them on things like your financial analysis, valuation, especially to do stock pitches and stuff like that. Yeah.
Someone from SUSS?
Okay, I will speak for SUSS. So, okay, I'm not taking the team for iFAST Festival, but I'll speak on behalf of SUSS Investment Group. So what we do is research. We have 2 research departments, equity research and global macro research. And we also have a support department, it's called strategic development. So they take care of the HR, marketing, and events. Yeah. So that's what we do.
Interesting. Okay. Yeah. So I think you all have more or less gathered from Ingwan's presentation that actually our approach, right? We don't really rely on fundamental analysis, but nevertheless, I think it's a good foundation. I think all of us, it's good for us to learn from the foundational topics of what exactly is fundamental analysis, how to analyze companies and stuff like that, because that really is the foundation for all portfolio managers. But as you progress and you move on, right, you also start to realize that actually all this so-called fundamental analysis, right, it has its limits. So then when you realize that it has its limits, right, that's what will propel you on to learn about other different approaches out there. So that is my own journey as well. I believe for Ingwan is the same. So I think it's a fantastic thing what you guys are doing.
Yeah. Okay. And I think about the exercise or the challenge that I throw you guys. Okay. Don't think too little of asset allocations. Like it sounds like a simple thing. Okay, but it's actually there's a lot to be learned inside an asset allocation exercise itself. And if you want to know one of the world's largest hedge fund, right, it's actually just based on asset allocation alone. And if you search out for Bridgewater Associates, Ray Dalio, under him, he runs an all-weather fund, which is almost $50 to $60 billion. And the entire concept is just basically on asset allocation. So you can make an entire empire and business out of this. So there must be something in there that people are looking out for, right? Yep.
Yeah, and I think there's research that shows that actually, if you look at the performance of a portfolio, right, investment portfolio, right, they say that something like 80% of the returns are actually explained by asset allocation. In fact, it might even be more than 80%. So it's the asset allocation in your portfolio, right, that really drives the performance you see in the portfolio. Yeah. So asset allocation is really something that is very, very key if you want to develop yourself into a portfolio manager.
Yeah. And in the end, even if the future they're only concentrated or focused only on stocks, and if eventually, let's say you become a portfolio manager of stocks, well, you will eventually also be facing this question: how much capital do I want to allocate to each stock? And it essentially will again be an allocation question again that you would have to answer. And that's what a portfolio manager's got to do. How much risk am I giving to each of this position that I'm going to have, right? Yeah.
Okay, that's all. I understand that some of us might have even more questions, and throughout this time that we will be having together, there will be more and more questions along the way. So please go and look for Patrick and Ingwan. Along the way, you guys can have all your questions answered. Now to end of August. That's the time. Okay. If you are very good friends with them, then I'll be happy to hear about any new upcoming hedge fund portfolio managers or any good trainees for AllQuant. Okay, thank you everyone. That's all for today. Have a good night.
Okay, good
Okay,
night.
thank you everyone. Bye bye.
Yes, thank you.
Right,
Yes, thank you.
Enjoy your
Good night.
weekend.
Thank you.
Yes, thank you.
Thank
Same to
you.
you. Thank you.